Okay, picture this for a second. You're a sponsor, you've just found this absolutely fantastic commercial real estate asset, the numbers look incredibly strong, and you've prepared a financing request based on a very solid target loan to value, or LTV. You go to the lender fully expecting a healthy 12 million pounds. But then, the term sheet finally arrives, and that expected loan amount, it has been unexpectedly and firmly capped at just 10 million pounds. So you're probably wondering, why?
Well, suddenly you are staring down a deeply painful £2 million funding gap. And honestly, this is a really frustrating reality that so many sponsors face. It immediately sets up this terrifying 11th hour scramble for capital, and it leaves a lot of people scratching their heads wondering why a perfectly great LTV ratio just isn't enough to secure the funds they expected. Well, today we are going to solve that exact mystery.
Welcome to The Explainer. Today, we're decoding something crucial: debt yield, the hard floor of commercial lending. It's this uncompromising, almost rigid metric that truly dictates your commercial real estate financing proceeds. It literally is the hard floor of the lending world, and fully understanding it, that's your secret weapon to avoiding those massive, unexpected funding gaps. Let's dive in. All right, kicking things off with Section 1, the metric that caps proceeds. Let's define what this restrictive metric actually is and understand this true floor we're talking about. So, the definition of debt yield in commercial real estate is actually elegantly simple, especially when you compare it to all the other underwriting metrics out there. It's just your annual net operating income, your NOI, divided by the loan amount. And it's expressed as a percentage. That's it. It's a direct, no-nonsense ratio of your property's actual income to the loan proceeds you're asking for. And notice how debt yield stacks up against your traditional metrics like LTV and DSCR. Well, LTV is super sensitive to shifting valuations, and DSCR bounces around with interest rates. Debt yield completely strips out all those easily manipulated variables. It takes absolutely no view on valuation, it takes no view on interest rates or structured amortization. It is completely immune to them, which is exactly why lenders rely on it so heavily. Ultimately, debt yield acts as a hard underwriting floor, not just some flexible guideline. As the source material perfectly puts it, it answers one question only. If the lender had to foreclose today, what return would the in-place income generate on the capital advanced? So, actually, scratch that idea of it being a target you can negotiate toward. It's not. It's a hard line in the sand. Moving right along to Section 2, how lenders resize the loan. Let's shift our focus over to the practical side of things and explore this whole reverse engineering mechanic. Because here's the mechanic that most borrowers never actually get to see modeled behind closed doors. When your proposed loan amount produces a debt yield that falls below the lender's threshold, they don't just toss the deal out. Instead, they solve backward. They start with their minimum acceptable ratio. Let's say they want a 9% minimum yield. Then they look at your annual in-place NOI, which, let's just say for this example, is £900,000. Finally, they use those two numbers to establish the absolute maximum loan proceeds that your income will actually support. So 900,000 divided by 9% equals a maximum loan of 10 million pounds. If you walked in requesting 12 million based on a 60% LTV, boom, the debt yield ratio instantly caps your proceeds, leaving you 2 million short. So the absolute crucial point to remember here is this. Debt yield acts as a proceeds constraint. It's not a risk score. It doesn't tell a lender whether or not to approve your deal. It tells them the absolute ceiling on what they can advance once they've already decided they like the deal. Falling short doesn't mean your deal is dead in the water, but it absolutely means your senior facility is getting slashed. And that forces you to scramble to fund that gap through additional equity, mezzanine debt, or preferred equity. Which brings us to Section 3, variance by property type. Because this hard floor isn't just some one-size-fits-all number. Let's contextualize these thresholds based on what kind of asset you're actually buying. Just take a look at the stark contrast in these thresholds. Multifamily assets, they typically clear at the lowest end, hovering around 8 to 10%. Industrial sits right behind it at 9 to 11%. Retail demands a slightly higher floor, usually 10 to 12%. But then, look at office and hospitality. These asset classes attract the most conservative thresholds out there, frequently demanding 15% or even higher. I mean, if you try to apply a multifamily benchmark to an office acquisition, you are going to massively overstate your achievable proceeds. And you might be wondering, why is there such a huge gap between them? Well, lenders adjust these thresholds based on two main things: perceived income durability and asset liquidity under stress. Multifamily is great because it has granular income spread across many units, plus deep secondary market liquidity. Office and hospitality, on the other hand, face serious structural demand uncertainty and volatile operational income. And on top of all that, these thresholds also shift depending on geography. Minimums in UK and European institutional lending tend to lean way more conservative than some Asia-Pacific markets, which just reflects different regulatory capital treatments and overall lender appetites.
All right, Section 4, the battle of three metrics. This is where it gets really interesting. We're going to pit LTV, DSCR, and debt yield against each other to see which one actually restricts your loan.
The broader economic environment plays a massive role in this battle. In a low-interest rate environment, DSCR is pretty easy to clear, and LTV is often super generous because valuations are inflated by compressed cap rates. In that specific setting, debt yield is usually the binding constraint. It's the bottleneck. But when rates rise, the whole dynamic flips. DSCR tightens up as debt service costs climb against a fixed income base. So in high-rate environments, DSCR is usually the one that binds and caps your proceeds, while debt yield just sits there as a baseline floor.
So let's actually put this into practice with a real-world scenario. Imagine you are the sponsor. You are targeting a nicely stabilized logistics asset, and you're aiming for a 65% LTV. You run the numbers on the appraised value and you think, okay, I know exactly what I'm going to get. But watch how these supported loan amounts actually stack up. If you look at LTV alone, sure, it supports a £20 million loan. Incredible. But wait, when you test it against the lender's DSCR minimum of 1.30x coverage, the loan drops down to $18.8 million. And finally, when tested against a 9.5% property-type debt yield threshold, the supported loan amount plummets to just £17.6 million. And in commercial lending, the lowest bar always wins. Always. The senior facility is sized to $17.6 million, not the $20 million your headline LTV implied. Relying only on LTV in this case just created a pretty devastating surprise for your business plan. And that leaves you with a £2.4 million shortfall. I really want to focus on this exact number for a second, because this £2.4 million gap, that is the difference between a smoothly structured capital raise that you planned for months ago and a desperate 11th hour scramble to save the entire deal before closing. Let's move to Section 5, lender context and refinancing. Because it's not just about the raw math today. We have to look beyond the numbers to see what happens when the loan actually matures. See, the debt yield ratio doesn't just magically disappear once your loan closes. Think about the life cycle here. At origination, you are tested against day one thresholds. During stabilization, you might be tested against stabilized NOI. But at refinancing, you are retested against the new current market thresholds. A ratio that cleared super comfortably at origination might fail miserably at refinancing if interest rates have risen, or income has softened, or even if your new lender just decides to apply a more conservative property type threshold than your old one did. And let me tell you, lenders scrutinize these inputs heavily. If you try to bring a pro forma NOI built on highly optimistic projected rent increases, lenders are going to aggressively stress test it right back down to trailing in-place income. Your track record matters immensely too. Unproven sponsors, they're going to find themselves held to the absolute strictest, most conservative end of the threshold, with basically zero room to negotiate. And finally, keep in mind that the type of lender really matters. Private debt funds and bridge lenders are typically much more comfortable underwriting to a projected stabilized NOI as long as you have a clear execution plan. But traditional banks and insurers, they'll demand you clear the threshold based strictly on in-place income. No exceptions. All right, final stretch. Section 6, preparing for your lender. Let's pull everything together into an actionable playbook derived right from our source material so you can use it to your advantage. So before you ever even reach the term sheet stage, here is exactly what you need to do to protect your negotiating position. First, run all three metrics, LTV, DSCR, and debt yield, knowing full well that the lowest figure will always govern. Second, make sure you use the correct property type threshold. Do not, under any circumstances, use multifamily benchmarks to model an office deal. Third, stress test your own NOI before the lender does it for you. Present the in-place figure right alongside your forward-looking assumptions to show you're realistic. And finally, size your equity gap early. You want to identify the mezzanine or preferred equity you need before you enter lender conversations, not after you get a surprise haircut. And that brings us to our final thought for this explainer. Sponsors who focus solely on leverage targets almost always find themselves completely blindsided. By truly understanding debt yield, you ensure there are zero surprises when it comes time for credit approval.
So as you look toward your next commercial real estate deal, I want to leave you with this one question to think about. Are you negotiating against the wrong constraint? Dive into those numbers, stress test your deals, and make absolutely sure you know where your hard floor lies. Thanks so much for joining me for this explainer, and happy modeling.